You've done the math. You know your number. Maybe it's $700,000, maybe it's $1 million, maybe you're still building towards six figures. You've got dividends coming in or a plan to get there. For the first time in a while, you feel like you're actually ahead of it. That's usually the exact moment right before someone finds out they were $185,500 short, and they didn't make a single mistake to get there. They just never saw this bill coming because nobody put it on the list. Meet Mark. Mark's 52. He spent the last 6 years doing everything you're supposed to do, maxing out his 401k match, building a dividend portfolio, running the numbers every few months. He's got a real plan. He knows what his retirement income needs to look like. What Mark's spreadsheet doesn't have is a single line for healthcare, because in Mark's head, that's what Medicare is for. He turns 65, Medicare kicks in, problem solved. It's not solved. And by the end of this video, you're going to know exactly what Mark doesn't. The real 2026 number, the 5 mechanisms that can make your version of that number bigger or smaller than his, and the formula to plug your own numbers into so you're not finding this out the way Mark's about to. Here's where we're headed. First, I'll show you the actual 2026 number. It just moved, and it moved a lot. Second, I'll walk you through the 5 hidden mechanisms that decide whether your personal bill lands above or below that number. Most of these aren't in any retirement calculator. And third, I'll give you one formula to find your own real number, plus where the money to cover it can actually come from, starting this month. Let's start with the number itself. Every year, Fidelity puts out a retiree healthcare cost estimate. They've done it since 2002, when the number was $80,000. In 2025, it was $172,500 for a single 65-year-old retiring that year. In July of 2026, Fidelity released the new number, and it jumped to $185,500, a 7.5% increase in a single year, one of the biggest one-year jumps this report has ever had. If you're married and you're both 65, double it. Fidelity's own 2026 breakdown puts a couple at $371,000 across retirement. Here's the part almost nobody explains. That number isn't for a decade. It's not for 20 years. Fidelity assumes original Medicare, Part A, Part B, and Part D, for the rest of that person's life expectancy. It's the whole remaining bill in today's dollars for premiums, co-pays, coinsurance, and prescription drugs. And here's exactly where that $185,500 goes, because this is the part your calculator skips entirely. 45% goes to Medicare Part B and Part D premiums, the monthly bill you pay just to have coverage. 48% goes to cost, sharing, co-pays, coinsurance, deductibles, and the stuff Medicare straight up doesn't cover, like vision and hearing. 7% goes to out-of-pocket prescription costs that Part D doesn't fully absorb. Add it up, and less than half of that number is even the premium. The other 55% is Medicare's gaps, and that's the mistake almost everyone makes with this number. Let's talk about that mistake directly, because it's the whole reason Mark's spreadsheet is wrong. I call this the Medicare Mirage, the belief that turning 65 and getting a Medicare card means your healthcare costs are basically handled. It's an easy mistake, because for most of your life, I have insurance has meant I'm covered. Medicare doesn't work that way. Original Medicare doesn't cover routine dental work. It doesn't cover vision, no eye exams, no glasses. It doesn't cover hearing aids. It doesn't cover most over-the-counter medication. And it does not cover long-term custodial care, the kind of care where someone helps you with daily living, not medical treatment. That last one is its own separate mountain, and we'll get to it in a second. That 48% cost-sharing slice from a minute ago, that's the Mirage in dollar form. It's not a rounding error. It's almost half the bill. And here's the part that should actually worry you more than the sticker price. Medicare premiums by themselves aren't flat either. What you pay for Part B in 2026 depends on your income, and not this year's income. 2 years ago's income. That's mechanism number 2. And it's the one that catches people who think they've already done everything right. This is called IRMAA, the Income-Related Monthly Adjustment Amount, and I call the mechanism behind it the 2-year echo. Because a financial decision you make today doesn't show up on your Medicare bill today, it shows up 2 years from now. Your 2024 tax return sets your 2026 Medicare premium. Your 2025 return sets your 2027 premium. So say you sell a rental property, or you do a large Roth conversion, or you have one unusually good year of capital gains. 2 years later, Medicare charges you more, even if your income has already dropped back to normal. Here's what that actually costs in 2026 dollars. The standard Part B premium is $202.90 a month. But if your income 2 years ago was between $109,000 and $137,000 as a single filer, double those numbers if you're married filing jointly, your premium jumps to $284.10 a month. Between $137,000 and $171,000, it's $405.80. And at the top tier, over $500,000, you're paying $689.90 a month, more than triple the standard rate. This isn't a gradual slope either. It's a cliff. Cross the line by $1 and you pay the entire higher tier for the whole year, on top of a matching surcharge on your Part D drug plan. There is an appeal, Form SSA 44, but it only works for specific life events: retirement, a spouse's death, divorce, work stoppage. A one-time gain from selling an asset doesn't qualify, which means the single biggest lever you have here isn't fighting IRMAA after the fact. It's knowing, 2 years ahead of your Medicare enrollment, that a big income year is going to echo forward and cost you. That's Mechanism 2. Mechanism 3 is the one that matters most if any part of your plan involves retiring before 65, which, if you're the type of person maxing out contributions and running the numbers early, might be exactly your plan. Medicare doesn't start until 65. If your plan is to retire at 60 or 62, you need coverage for the years in between. And 2026 just made that bridge more expensive for a lot of people. I call this stretch the bridge gap. For the last several years, enhanced ACA marketplace subsidies made that bridge a lot cheaper than it used to be. Those enhanced subsidies expired on December 31st, 2025, and Congress didn't renew them. So starting with 2026 coverage, the original ACA rule is back. The 400% federal poverty line cliff. Cross above roughly $84,600 in income for a two-person household, and your subsidy doesn't shrink gradually. It disappears completely. $1 under that line, a couple might get $15,000 to $25,000 a year in premium tax credits. $1 over it, they get zero. For a 60-year-old couple bridging the gap to Medicare, that can mean the difference between paying a few $100s a month for coverage and paying $2,000 or more a month, full price. That's not a small planning detail. That's the difference between early retirement being realistic or not, depending entirely on how your income is structured in the years before 65. Before we get to the good news, there's one more number, and it's the biggest one on this list. It's also the one Fidelity leaves out completely. Remember, Fidelity's $185,500 assumes original Medicare only. It explicitly does not include long-term care, the kind of custodial help with daily living that Medicare never pays for, no matter how long you're enrolled. I call this the number they don't count because it's usually the single largest healthcare adjacent expense a retiree ever faces, and it's sitting completely outside the headline figure everyone quotes. Here's what it actually costs from the most recent GenWorth/CareScout Cost of Care survey. A private room in a nursing home runs $129,575 a year. A semi-private room is $114,975 a year. Assisted living is $74,400 a year. And that one's rising faster than any other category, up 5% in a single year. In-home care, a non-medical caregiver for 44 hours a week, runs $80,080 a year. None of that is hypothetical, and none of it is in your $185,500. You don't need to plan for the worst-case version of every one of these. Most people never need decades of nursing home care, but even a couple of years of assisted living is a six-figure event sitting completely outside the number you've been budgeting toward, which is exactly why the account we're about to talk about matters more than most people realize. If you have a high-deductible health plan, you can contribute to a health savings account, and in 2026, the limits are $4,400 for self-only coverage, $8,750 for family coverage, plus an extra $1,000 catch-up if you're 55 or older. Every dollar goes in tax-free, grows tax-free, and comes out tax-free for medical expenses, including expenses from years ago as long as you kept the receipt. There's no deadline on reimbursing yourself. Here's the part most people never use. At 65, the account flips. I call it the HSA Flip. Before 65, a non-medical withdrawal costs you a 20% penalty plus income tax. After 65, that penalty disappears completely. A non-medical withdrawal is taxed exactly like a traditional IRA, income tax only, no penalty. Medical withdrawals stay 100% tax-free forever. So an HSA that's been growing for 15 or 20 years isn't just a medical fund anymore. It's one of the most tax-efficient retirement accounts you're allowed to have, and most people never build it up because they treat it like a checking account for co-pays instead of an investment account. One warning that belongs right here, because it trips people up at the exact moment they're transitioning into Medicare. When you enroll in Medicare Part A after 65, your coverage gets backdated up to 6 months. If you were still contributing to an HSA during those backdated months, the IRS treats that money as an excess contribution, a 6% excise tax every year until you fix it. The fix is simple. Stop HSA contributions at least 6 months before you apply for Medicare or Social Security. Just don't let the account run on autopilot straight through your enrollment date. Okay? The Mirage, the Echo, the Bridge Gap, the number they don't count, and now the Flip. 5 real mechanisms all sitting underneath or outside that $185,500 number. Now let's turn this into your number, not Fidelity's. You don't need $185,500 sitting in cash the day you retire. You need enough invested, growing, that it becomes $185,500 by the time you need it. Let's run 3 timelines using a conservative 6% average annual return. Conservative on purpose, because I'd rather this math hold up in a bad decade than only work in a great one. 15 years out, say you're 50, to land on $185,500 in 15 years at 6% growth, you need about $665 a month, roughly $7,970 a year. That's comfortably under the 2026 family HSA limit of $9,750 with the catch-up included, which means an HSA alone, invested and left alone, can realistically cover this entire number for you. 10 years out, say you're 55, same target, shorter runway, needs about $1,175 a month, roughly $14,100 a year, to get there by 6% growth alone. 5 years out, say you're 60, this is where the HSA alone can't carry it. Even maxed out every single year, 5 years of $9,750 growing at 6% only gets you to roughly $55,000, about $130,000 short of the target. At this stage, the HSA is still worth maxing because every dollar in it is tax-free for medical costs. But the rest of that gap has to come from somewhere else, which, on this channel, usually means the dividend income you're already building. That's not a reason to panic if you're in the 5-year bucket. It's a reason to know the real number now, instead of finding out at 65 the way Mark's about to. So here's the one formula I want you to actually write down. I call it the real number. Your real number equals your current retirement number plus $185,500 if you're single, or $371,000 if you're married. Then adjust up if any of the 5 mechanisms we covered apply to you specifically. Big one-time income years before 65? Add a buffer for the Echo, retiring before 65, price out the bridge gap for your state, already close to those IRMAA thresholds, budget for the higher premium tier, not the standard one. Figuring out that number is half the equation. The other half is knowing how much income you need coming in to actually cover it without touching principal. And that's exactly what the free Dividend Snowball calculator in the description does. Plug in your real number, and it shows you how much dividend income closes that specific gap, on your own numbers, not Fidelity's average. Quick recap before we wrap up. The 2026 number is $185,500 single, $371,000 married, up 7.5% from last year. That number gets bigger because of the Medicare Mirage, the 55% of costs Medicare doesn't fully cover. It gets bigger because of the 2-year Echo, IRMAA charging you today for an income spike from 2 years ago. It gets bigger because of the bridge gap, the now more expensive stretch before 65 if you're retiring early. And it gets smaller, a lot smaller, if you actually use the HSA Flip, building that account for 15, 10, even just 5 years instead of draining it as you go. Remember Mark? He's not behind because he did the math wrong. He's behind because his spreadsheet was missing a line item nobody told him to add. Now you know what goes on that line, and unlike Mark, you found out with enough time left to actually do something about it. Drop your real number in the comments, your current retirement target, plus the $185,500 or $371,000 depending on your situation. I read every one of these, and I want to see how big that number actually looks once healthcare's on the page. And if you're looking at that real number and wondering how dividend income actually closes a gap that size, watch How to Live Off Dividends. Starting at your 40s or 50s, you're not late. Next. That's the exact math for building the income side of this equation, starting right where you are.